Yep.
Mike, when we talked about a year ago, I'll bring my microphone a little closer. When we talked about a year ago, and I think we talked probably for about 2 hours, and so I kind of forget even what I've said to you specifically at that time. But what were some of the lessons? What were some of the things that I did share with you that you found were helpful?
Well, I think a lot of the questions I had for you were probably a lot of the questions that anybody who's just getting into investing would have. What should I buy? How much of it should I buy? Should I sell it if it goes to this? And more than anything, you kind of hammered in on just the concepts, how to put together a portfolio, why you would buy a certain stock, why you wouldn't, what to look for. One of the things that you said to me in terms of putting an overall portfolio together, I think is really easy to understand. I still kind of structure mine that way. And you said that you should always have a portion of your portfolio tied to something secure, the S&P, Dow, something of that nature. What that percentage should be is going to vary based on your age, your risk tolerance, if you will. So say, for example, that was 50%. You have 50% of your overall assets that are going to be tied to a major index like and then the other 40, 50%, whatever it might be, you kind of directed me, you said that's where you can place it into your different buckets, your different individual stocks. And I think just that concept alone helps kind of understand where you should be. If you take that concept and you do tether a large portion of your assets to something that is relatively secure, then, do the other taxes matter? Well, of course they do. They're always going to matter, but you're not taking an overly aggressive stance in one company that may or may not make it. So obviously you do that, and you start placing your money in these different buckets, what's working and what's not. Some of those buckets, some of them I found on my own. I called you, said, yeah, no, that does like a worthwhile investment. So I think more than anything, because everybody wants to know what's the next, home run stock, right? And we had the crystal ball, we could give them that answer. Concepts you've instilled in me, and I think they go well beyond a year. I mean, I would say that, having you in my ear for the last, my entire life has played to my advantage. So this last year, I'll say, was unique in that we had a pretty significant crash back in
Yeah, you
March,
started
April.
actually right at about the low of the market, right after COVID came out. So it's actually it was kind of fortuitous. You got in at a good time in that the market was low. And
I did, and I recognize, because if you would have invested any amount of money into a majority of stocks that are traded at the time that I got in last year, you would have made money. Um, Market, crisis like that, and then we have that V-shaped recovery. Then your hands on the going to do okay. So I got in at a good time. It was something that I wanted to do, and your brother Mark, my other uncle, said to me years ago something that so you're not going to wait for opportunity. Well, here I was wanting to invest a little bit of it aside, so I was able to do. What better opportunity am I going to get? The market 30% in 2 or 3 days. I mean, that doesn't happen very often. I'm sure you can probably count on one hand the number of times it's happened in your lifetime. So, that opportunity in front of you is big. You have to recognize, okay, a great opportunity for me to, execute on thing I'm wanting to do.
the thing is, when you got in and you knew you were getting in low, so you might have thought, well, this is great. I get to start when the market came down and I can buy these things cheap. On the other hand, if you had been in, let's say you had started a year earlier and then things are down, then you're going to be looking at it negatively, right? Oh my gosh, all my portfolio is down so far. And what I would say to people is, you should look at it like you're just starting. Like when the market goes down, don't worry about the fact that your portfolio is down because it's only momentarily down. What you should look at is that this is an opportunity to buy items that you want to buy, stocks you want to buy when they're cheaper. And we just saw a lot of the tech stocks. Facebook came down, Amazon came down. Amazon was just a couple of weeks ago at about $3,400 a share. And of course, a lot of people can't afford to even buy one share, but just as a point, it recently just came down below 3,000. TTD, which is a stock I really liked and started investing in a year ago at about 225, went all the way up to 900. And then more recently, it was down to about 650. Now, that's still very expensive on a per share price, but not when you compare it to where it was at $900. So anyway, the point is, I think you have to train yourself to how you look at the market, and that's where I just say, trying to make it simple as a concept, when do you want to buy a Cadillac? When it's $80,000 or when it's $15,000? So when the market goes down, that's a great time to buy. Mike, let me ask you this too. Where do you go? Because people ask me, and there's a variety of things I would look at. When you pick a stock, it's not that I'm feeding you. I've given you some ideas of things to invest in, but you've picked other things on your own. So what do you base your investment decision on? How do you determine in your own mind if something is worth putting some money into?
Well, I try to look at things from a couple different angles, and I also try to not overthink it. I mean, you've got a lot of information at your fingertips. I use YouTube a lot. Personally, I don't love to read. I will, but if it's in a video format, I will ingest a lot more information and retain it that way. So I go to YouTube. I will go to company's website. I will read the big publications, the Market Watch, and things like that. Because if you're watching YouTube videos from people that are doing the same thing, if you're reading Market Watch, Wall Street Journal, whatever it is, there's going to be things that align with all of those. Meaning, you're going to see a trend. Whether that's they're all talking about genomic stocks, whether they're all talking about the same stock, whether they're telling you the market's due for, and you can kind of make your own determination based off of that. So I will put things on my watch list. To your point, just a minute ago about buying things that if there's a stock that you're interested in, the first thing I do is put it on a watch list. I simply just watch the price. If I start watching it at $20 and I see it goes to $30 and then I see it goes to $40, and let's presume that's in a 6-month time frame, well, perhaps my indicators were correct months ago when I started watching it. The stock has doubled. So the information I was getting at that time was true. If you see that same stock, in a week like we had this past week, go back down to say $20 or $25, presumably that would be a good time to pick that stock up. You watched it organically go up, and because we're having this correction, it's dropped in value and is probably a good deal, for lack of better terms. So I get my information from a lot of different sources. I think having your finger on the pulse of things is important. I will say this, and I was talking to, my brother, your other nephew, one of your other nephews, and he, like me, he's, just getting into investing, and he was asking me questions about, what about this? And my answer was, I don't know. He asked me 3 or 4 questions in a row, and my answer was, I don't know. And I think knowing, that you don't have the technical savvy to day trade or do, trading options and margin calls and things like that, that's above my pay grade. It's something that I don't necessarily have the technical understanding of to feel confident in doing it. So if I read something that says, this is going to be a good, swing trade option, well, I'm not touching it because I'm not a swing trader. I just simply don't have the time in my day to do that. If I see the same stock mentioned by 4 publications, and 3 of the 5 guys that I trust on YouTube are all talking about it, that gives me a pretty good indication that there's probably something at that point. That's probably something I would feel okay investing in.
I
Which,
would say to people they shouldn't be thinking about day trading. To me, that's not a get rich quick scheme. That's more like a get poor quick scheme because
right,
you just
right,
don't know. I mean, to be successful at that, as I often say, one of my common statements is nobody has a crystal ball. Not me, not Warren Buffett, nobody. And you don't know if the stock's going to go up the next day or not. And even if it does, and I'll share that, when Facebook came out, I thought it was overly priced. And I was right on the IPO. It came from about 35, fell to about $25, and I bought it. I happened to get it just at the low, and then in about a week it popped back up to 35. Well, when it goes up 50% in a week, often something will come back down. Now, the mistake I made is I sold all my Facebook thinking it's going to come down, and then I'm going to use that profit I made to buy even more shares. It never came down. And the next time I bought Facebook was at $112. So when you're day trading, you run the risk not only of losing money on the stock price, but losing money on the price where it goes up and you're no longer on board. So my mistake was I could have sold maybe some of my shares on Facebook and if it came down, but not get off entirely. I'm not a fan of that. I wanted to make that clear when we say day trading, that's not something I'm a proponent of. What I think for the purposes of this interview, it's just that sometimes people ask me questions and it's like, gosh, I haven't thought about that in 30, 40 years. And because it's been so long ago that I was new to investing that I forget what some of the concerns are. I would just say that if you look at, Mike, as you have said, and if you look at a trend, I mean, when I bought Cisco, and I've said how I made a lot of money on that, and Uncle Mark did as well, we were buying when the internet was just coming out, and Cisco was going to be the chief architect, you might say, of making the gear that was going to be on the internet. So you could just say the internet wasn't going to be getting smaller, it was going to be getting bigger. And so it had that impetus. When we look at society now, we can look at trends. We know we're going to be going maybe to automotive cars, although that might take longer than we think. We're going to have the human genome, going there. We're going to have digital currency, and we see things like Humble and like Bitcoin and all of these digital currencies. So one of the things I think is interesting and is that when you start investing, you start paying more attention to what's going on in the world, and you start to see the connections. And I'm curious to have you noticed that? Have you noticed that in yourself? Because I don't necessarily think of you as being a news hound, like in the same way that I've always been so fascinated by the news. But to the extent that you started investing, did you find yourself like all of a sudden seeing the connections between how what's going on in the world pertains to the world of investing?
oh, absolutely. I think you can help but to not notice. What you said that to me a year ago. You're going to start seeing how things are connected and how one industry may affect another, and how a current event might cause a stock price to fluctuate 15%. And yeah, sure enough, over the course of a year, and let's be honest, 12 months ago till today has been quite a tumultuous year, and we've had no shortage of I'll say, catalyst, that would cause a stock to do one thing or another. But yeah, absolutely. I mean, one of the recovery plays that we talked about were some of the cruise lines and the airlines. Now, you said to me, never in my entire investing career would I really advise someone to purchase these. However, we're going to be coming out of this at some point, right? We're going to be coming out of this pandemic, and airlines will continue to add flights, and the cruise liners at some point will resume their cruises, and assuming those companies don't go bankrupt, they really only had one direction. So just kind of keeping a pulse on that. I did buy some Norwegian cruise liner, and thinking that, okay, that's selling right now.
About what
The
price did you get in to Norwegian?
it was around $16, I think it was.
And I'll say for people, it recently, and I think I told you my target on that was $30 because based upon where it had been prior to the pandemic, I think it had been about $60. So I just took half of that. Here it went from 60 all the way down to 16 because they weren't cruising. The other thing is we noted that they had $1 billion in cash, or actually $3 billion, because they borrowed to. And my thought was that's going to be enough to get them through and to the other side where they can start cruising. I'll say that, yeah, this past summer it sat at 16 for a long time, and that's where people could use that, news and pay attention to things like how much cash do they have. But more recently now, it's gone up to 30. It's gone even up to about 33, and I think right now it's at about $29 or so. So that's just one example, I say, for the viewers, because we want them to. What I would want them to get out of the interview with Mike is that, Mike sharing his lesson of getting started and how you just got to start. Again, it's like dating. People can talk to you, but you have to experience things emotionally. And when you're in the market, you're going to have the thrill of it going up, and you're going to have the pain of it going down. And I talked just the other day about volatility, and markets are going to go up and down. And the volatility, if you accept that it's an opportunity when it goes down, then you're not going to be so depressed about it and fearful. And the last thing you don't want to be jumping out of a stock when it goes down, because that's how you guarantee that you take a loss. Unless there's some really significant bad news that is specific to that stock, like the Feds come out and say they've been playing with their books. Okay, in that case, get out of it as fast as you can. But If it just goes down because the overall market goes down, as I said in a tweet earlier this week, I put up a graphic of Amazon again. I think most people would accept that Amazon is a very strong company. They ought to accept that. But this last month, it's gone down a lot. Well, I don't think anyone's saying head for the hills because Amazon went down this month. I think on something like that, people just accept, oh, okay, yeah, it's just down. And that's true of a whole lot of companies, where the companies are solid, but they're going to go up and down, kind of like boats on the tide coming in. When the tide goes up, they're going to go down. When the tide comes in, they're going to go up. So you have to get used to the waves that the market goes through. Over time, it's going to be going up. And I think that when we buy trends, you don't have to be that sophisticated, but you just have to see the trend in something where it's going to be expanding. And to that extent too in the news, and I don't mean to filibuster here, Mike, but I told a friend to buy what was before called Taser, and in July of 2016, and she bought it at $29. It's now, I don't have it in front of me, but more recently it was all the way up to about $160. I think it's come down a bit. Now, why did I pick that? Because they had just, aside from tasers, which you don't have to really, once you have them, you don't have to buy a whole bunch of them because you don't shoot them off that often. But what they were doing, and the trend was police wearing body cameras, and then having that body camera video stored so that if I'm Officer Smith and I arrest Mike, and Mike comes back and sues the city and says, I beat him up when I arrested him, the city can go back to Taser, or actually now called Axon, and look at that video on October 2nd at 3 a.m., and they'll see, did Officer Smith beat up Mike or did he not? And that can save the cities a lot of money, as long as the cop was innocent. So the point is, that's recurring income. So it's one example, not specific just to that, but You see the connections when you're investing between what's going on in the world, and conversely, when you sometimes see a trend, then look for a stock that maybe you can buy that's participating in that new trend coming along, as we did with Cisco years ago when the internet started.
Right, and to that point, you don't have to be, you don't have to have the home run. Look at the trend of let's take a recovery play like Dig or Gush, one of the oil ETFs. Now, whether you feel good or bad about the use of fossil fuels is irrelevant. As a society, both domestically and globally, we're going to be using oil for at least the near future. And something Terry, you and I have talked about at pretty good length. What are we using today, and then how much is going to be using? You know, 3 months, 6 months. Trend of that is increasing. Using X amount, I don't know how many tens of barrels it would be, but presumably, given that there isn't a second virus and something else catastrophic doesn't happen, we're going to be using more oil in the future than we're using today.
We just have to, don't we? I mean,
Just
once we start
the way
driving
it
more
is.
and flying more, we're going to be using more oil. You can't get away from it.
Exactly. And, somewhat on the same point of that, something that I'll say this just because I think it would help a lot of people that are right where I'm at, or even, a few months behind me and, brand new in the investing world is understanding risk. Now, Terry, you know this, I work in insurance. So, we look at risk all day long. And I think when you are investing, it's irrational fear of loss, meaning you don't want to put something, money into something that you think is going to go down. I would say that, everybody who puts money into a stock has a belief that that is going to go up. Why else would you put money into that stock or that company? And understanding that, like you said, you only lose money if you sell when the stock goes down, But also, let's say, for example, I don't know what the average median income in the United States is. Just call it $50,000. So if someone is making $50,000 and living within their means, meaning that they don't have a home they can't really afford, and cars and a lifestyle they can't really afford, they're probably going to put some money aside. So let's say that's $300 a month. Well, if somebody puts $1,000 into a stock, and that stock, drops in value by 50%, well, they've lost $500 or 50%. But at the end of the day, is their life going to be affected? Probably not. Maybe some emotional stuff in the short term. The lights aren't, going to be turned off. No one's going to come repossess their home or their car over that small loss. So, you've talked to me at length about it. What kind of risk are you really taking? Are you going to mortgage your house and put it all in one stock? Of course not, right? But just understanding, what does it mean to risk something, and then what is the true risk there? Are you going to invest in something that could go to zero? I guess anything could go to zero.
Well, theoretically it could, and that's a point. Very few stocks go to zero. Now they can certainly go down, but they don't go to zero. So if you're putting in $1,000 or $5,000, first of all, you're probably not really putting at risk $5,000. I mean, theoretically you are, but realistically, maybe you're putting at risk $2,500 because it's probably not going to go down more than half by 50%. And if it does, then you didn't do any homework. You shouldn't just be throwing darts at the Wall Street Journal stock page to pick your stocks. You have to have some reason why you think this is going to be a growing company and have done some research, as we already talked about trends. But I think, Mike, you're right. There is an unreasonable concern about losing money. And what I think people don't realize is, to what extent are you losing money by not investing? And the other thing is, let me tell you, or ask you this. When you put in money and you've seen it grow by 20% or 50%, I don't know what your biggest gain has been. I think the other thing, it helps you be a saver because you start realizing when I save $1, I'm not just saving $1, I'm saving maybe $1.50. I'm saving $2 because those are your seeds, and you're going to plant those seeds in the market for them to grow. So when you're saving, you're really saving. You're realizing, I should say, a growth of money that is far beyond the actual dollar saved.
Absolutely, yeah. You begin to kind of reframe the way you look at money. I think. I don't think you can help but to, your relationship with it changes.
Yep.
Personally, I started looking at. Oh, well, to answer your question, my biggest gain was you're going to laugh. It was a free stock I was given when I signed up for an account with a particular brokerage. I now have two accounts. This is one of them. They gave you a free stock. I didn't know anything about it. It was a solar company. And I can't even remember how many shares. I think I got it for $4, and I might have bought, 100 shares or something like that. And it wound up about 10x.
Wow.
I didn't know anything about it. I knew it was a solar company. But again, I just bought the trend, and it happened to take off. And, so that was my biggest gain. So, yeah, when you look at that investment of, say, $400, well, I could go buy a few new pairs of shoes, or I could put $400 into. There's a handful of stocks that I've looked at this week that I think will probably, gain 50 to 100% over the next 6 months, just given how bad they've been beat up, over the course of the past couple weeks. So, yeah, I think it changes the way you look at,
Let me ask you, what were your biggest losers, and how did you handle when you saw your portfolio value go down?
Well, it's a tough pill to swallow, no matter what. You don't want to put money in that, you see almost immediately disappear. I purchased I don't even remember the name of it. It was a highly leveraged oil ETF. Sounded sexy, looked sexy, had a cool name to it. And I don't even remember when I purchased it. Probably at its high point over the summer when things were looking really good. Mm-hmm. And then they announced a new strain, and, this country was locking back down, and, you name it. And
that was around the 4th of July. In June, we thought we were coming out of this. And exactly. Then I think there was a new strain, and just around the 4th of July, then the market, oh God, here we go again, and the market went down.
Exactly. So I don't remember the value. It wasn't, too significant, but I experienced my first reverse split, and not the good kind of reverse split that we've seen with TSNP. This is the kind that everybody fears. And I remember calling you, and you said, "Oh, that's not good." And I said, "Well, I figured that much." Thankfully, I didn't have a ton of money into it, but I was able to. I watched it over the course of the next week. It came back up a little bit. I sold off, and I lost a little bit. I'm sitting on some pretty big losses right now.
On paper.
Just on paper.
But the thing is, when you buy 100 shares, you still have your 100 shares. You have what you bought. It's just the relative value change. But sometimes we buy a home, the relative value changes on homes too. You don't go, oh my God, my home price is down. I mean, maybe you do. Anyway, the point is you still have the number of shares, and because the market goes up and down, even if you're down on paper, as long as you haven't sold low, you still have those 100 shares that can go back up in value. Exactly.
It's paper, and I bought. There's two in particular that I'm down, about 40% on each. Obviously, that's not a good thing, but my belief is still there in those companies. I think that.
Do you want to say what they are? Or?
Yeah, one of them is Sens. It's Sensonics.
Yeah.
Exactly. Yeah, they've got the glucose monitoring system that's slated to be approved by the FDA. And going back to our previous point, attention to what's going on in the world. Well, the FDA has been basically put on pause because of the vaccine distribution. They've had to push a lot of things to the back burner in the short term so they can accelerate the approval of these vaccines. So
Now, is that
what
the
does
kind of
that
thing
mean?
you would have known before you invested?
I'd love to tell you yes, but no, I can't say that I would have. And that's the thing, you get down these rabbit holes on whatever it is, the internet, I'll say, YouTube, whatever, and you learn things. You can't help but to learn things. Not everything you read or watch or see is going to be correct, but you can grab little tidbits of information and put the pieces of the puzzle together. So I bought some of that stock. It went up considerably. I actually sold it and made a short-term profit. I just, it was almost too good for me not to take some money off the table. So I'm glad I did that. I then read two or three more positive points on that particular stock that made me say, okay, I think maybe this is worth, putting some money
You know,
into.
you made a point there, though, I want to underscore. You took some money off the table when it went up. Now, I don't know if you sold all your shares. The thing I would say, I've said this before, but it's worth repeating. One of the greatest things about stocks as compared to a home or a car is you can buy it in pieces, your position, and you can sell it in pieces. You can have 10 shares and sell 5 shares if it goes up, or 7 shares. And you don't know if it's going to continue going up, so you could keep some shares in the position so that if it goes up, you're still going up with it. And then if it goes down, you took some money off the table. And that's the thing that I think sometimes people, when they have a position and it goes up, they're so in love with the stock, well, I'm not going to sell any of it. And that can also be a mistake. Here and there, as I said the other day, I use a euphemism, now and then, pick an apple off the tree. And by that I mean take some of the profits, take some. You don't have to take all the apples off the tree. You don't have to get entirely out of a position. But take some money because you also, as I say, you want to build up your cash reserves because once in a while the market's going to take a severe dive, and and most of the time we don't see it coming, but then you'll have cash available to go and make even more money by buying good companies low. And I would also say to that, people should, generally speaking, build a portfolio around companies that are not penny stocks. You can play around with some penny stocks and they can make you some money, but you also want to be investing in things that are not just penny stocks.
Right. I mean, a couple points there. I mean, you've reminded me frequently over the past year or so that cash is a position.
Right.
And, you've got, $10,000, $100,000, whatever it is, a portion
Or
of
you
that
got just
being in cash.
$3,000 or $2,000. I mean,
Right. And the first time I put money in the market, $1,000 a significant amount of money. I think I lost 1,000 in the first 3 days and thought to myself, this stuff's for the birds. But thankfully, my conviction was strong in not only the market, but also, what investing can do for you. So I continued the course, and I've since put more money in. But and I can't remember what point we were talking about aside from just having
well, it makes
some
you cash.
cash.
Since you've been doing it for a year, overall, are you up or down?
I'm up, and again, I'm not a financial advisor. Part of this was me doing my due diligence. I do have some wonderful resources here at my fingertips. Um, yeah, I'm up. I mean, probably about 130%.
That's
Now that
fantastic.
sounds like quite the oversized return.
Yeah, well, it
I
is.
think it is an
I mean,
oversized
from a
return.
from a norm that one would expect.
Right. Now, I will say, if you put money in the market when I did at about, the 20th of March of last
Which
year,
was
look at,
almost the exact low of the market. So,
I mean, almost the exact low, exactly. And I've continued to buy. I mean, let me be clear here.
so
I
when you
put
were
money in
buying,
the,
let me just say for the viewers, when Mike started, he just happened to, by luck, get in at the bottom of the market. So it was almost like shooting fish in a barrel. But I would also say this is why you want to have cash. So let's say you didn't just start like Mike did. Let's say you had started in 2018 when the market goes down. If you were following what we're saying and you built up your cash, taking some profits here and there. Maybe you got 40 shares in a position, and you could sell 10 if it really went up a lot. But you build up your cash. Then when the market goes down, you have cash to work with. You're not out of ammunition because you were fully invested. I just wanted to underscore that for people.
Yeah, exactly. I mean, one of the other principles, and we could probably do an hour-long video on that alone that you've talked about, is the velocity of money. Where is your money going to grow the fastest? And you use a lot of analogies, and I think that people understand those on a pretty broad basis. The one that you use with me is, you've got two individuals. You've got a 30-year-old man and you have a 12-year-old boy. Well, who's going to grow faster? Well, obviously the 12-year-old boy who's built is going to grow more than a 30-year-old. So in terms of if that's what we're looking for, and I think that's probably what anyone who's watching this or anyone who's investing is looking for growth, they want to put their money where it's going to grow the fastest, right? Now, is a 30-year-old going to grow? No, So
Well,
so that's
and as an example, so you get some new company like we've talked so much on the program that I talk about Humble, which is a new and growing company, just started in January. And if you contrast that to like Coca-Cola, and as I mentioned the other day, 5.5 years ago, the price of Coca-Cola was $45, and when I checked it the other day, it was $49, and that's after 5.5 years. It virtually has not gone anywhere. So when you might say, well, a new company is dangerous, it can be, but an older company like Coca-Cola can also be dangerous, or it can just be dead money. Another place that's kind of dead money is AT&T. The stock just sits there in the mid-20s. It's not going anywhere. So there are certainly lessons here, and I'm glad you brought up the velocity of money. Yeah, that's where I see people, they'll go, well, I have Coke and I have AT&T, and it's like, okay, but your money isn't going to grow anywhere. I mean, you would almost be better just having it sitting in cash because, or just buy the S&P 500 where you're automatically diversified and you're going to be getting about a 3% or so dividend. At least, I don't know what the dividend is in the S&P right now. I'm sorry, Mike, I cut you off though. I wanted to emphasize.
No, that was it. I mean, and to that point, there was, I talked about holding some Norwegian cruise liner. You and I both thought that was going to recover a little bit quickly.
Right. It took longer than we thought.
Exactly. And full disclosure, I when I bought in around 16, I wound up selling at $24. Now, the percent return is just fine with me,
Right.
in 9 months' time, to be
You're not
clear.
going to go broke taking 50% returns,
But I think that was one that both say we had conviction of then or was going to be probably the 100% return given going on in the world. I was okay with the 50% return. It had kind of stalled out in that $22 to $25 range. I took my profits, I reallocated them into something that I thought was going to grow faster. Now, what was that? That was DIG. I bought more DIG, the oil and gas ETF.
And I think you were right. I don't know what you got in, but it's gone up since that time.
Well, I mean, even if I would have kept my cash in Norwegian and taken it all the way up to whatever it got to this past week, 30, 31, 32, I still would have done better where I'm at and I simply got the velocity correct.
Right.
Was it a guess? It was an educated guess. I mean, it was one that we felt pretty good about. So in terms of velocity of money, if you would have looked and said, oh, you sold your Norwegian, it's doubled since then, shoot, you made a mistake. Well, no, I didn't. I put my money where it was going to grow faster.
Right. Once we started getting, folks, what I'm saying here is not really about Norwegian, but let's use this as a learning lesson. We thought in like June and July, that Norwegian at $16 was going to shoot up to 30 probably by October or so. And then what happened is, you start getting these different strains, and it just wasn't, it did get up to 20, but it just wasn't getting anywhere near where we expected it to go. So what Mike did is he took his money out of the cruise line that did go up, as he said, made 50%, but maybe there his money was growing on the financial highway at 40 miles an hour, and by jumping over into the other lane where there was DIG, the oil and gas 2 times leveraged ETF, he got his money growing from 40 miles an hour to maybe 65 miles an hour. And that is the kind of thought process, and it worked out for Mike. But that's the kind of thing that you want to review your portfolio. And I mean, you don't want to be doing this on a weekly basis, but if you've had some positions that are sitting there month after month after month, that's lost opportunity that you could reallocate those monies into something that's just not held up. Kind of like, as I say too, on a lane of traffic, if you want to drive 80 miles an hour and someone's driving in front of you going 55, what do? You change lanes. That's what you need to do with your money. Get your money out of the slow lane. And so that's where Mike took that, even as a new investor, and did it successfully. And it's not that I want to break my arm, pat myself on the back, but I want you to learn these lessons. And that's what, even Mike as a new investor, I never had any stockbroker tell me that. I mean, these are things that I had to learn over a long period of time, that now when we talk about this on the channel, we're trying to get the new investor to have a learning curve mastered that took me maybe 20 years, and that maybe hopefully you guys can do it in a year or so.
Well, exactly, and that's kind of why I bring up a couple of the points that I do, because I think they're valuable, and I think that, the whole purpose of this channel is to help other people, kind of accelerate their education. Exactly what you've done for me over the course of the past year, is just give people the tools. I mean, a couple times throughout the year, you've told me, you just shot me a quick text, hey, look at this stock, and, I bought it the day before. So that tells me that, we're thinking the same way. You've given me the tools that I need to go make those decisions on my own. Ultimately, that's the goal, right? You don't want to have to be dependent on someone else to give you information and make decisions for you. Know when to, consult someone, know what you don't know, but at the same time, I think you can, like we talked about with DIG and Norwegian, I saw that they weren't moving. And again, my belief that we were going to use more oil and gas hadn't changed, so why wouldn't I reallocate that money and put it in somewhere I think is going to grow a little bit faster? So, I look great today, when DIG and those oil ETFs are up, whatever they are, 15% for the week. But it's more or less just the concept, I think, that we're trying to, reinforce here. The concept of not only the velocity of money, but kind of read things as you go. Maybe, I think we're both willing to admit that we're probably wrong, at least in our timeline, about what some of the cruise liners were going to do.
Yeah, because we don't have that crystal ball. We didn't know there were going to be these different strains, etc. And I mean, even now in March of 2021, they're not cruising yet. I would anticipate that they will be, but in the months ahead. But I also said, which is why, by the way, let me jump over to DIG for a moment. DIG, which I told a friend to buy in November, after the first vaccine was announced, at $63, and now it's at $137. So she's up over 100% in about 4 months or so, 5 months. I mean, that's tremendous. So I said, look, you got 600 shares, you're up over 100% on those. Let's take 100 shares of that 600 shares, and we will start to sell that off periodically. So the other day, we sold 10 shares, or she sold 10 shares. I'm just giving her my thoughts on how to do this. But she sold 10 shares at 136, I think it was. So that's, when you're up to $136, 10 shares is $1,360. It's not an insignificant amount of money. And that's where you can have your cake and eat it too, in that you're taking some profits, and yet you're still having a good part of your position in the growth of the company. But if something, and there's always something that can come out of the blue. COVID came out of the blue. 9/11 came out of the blue. If something comes out of the blue and drives that price down, and let's say it fell, for the sake of discussion, down to $80, would you feel better that you had started to take some profits and sold 10 shares here, 10 shares there, maybe? Yeah, you're going to feel better, and you're going to have that cash. If you wanted to go back in and buy those 10 shares again, you could be buying those 10 shares back that you sold for 1,360. If we went to 80, you're paying $800. So you still got $500 in cash, and you bought the 10 shares back. That is successful trading. You position yourself to take advantage of the market fluctuations when they happen. If you don't have any cash left in your account and things go down, you're like a soldier with no bullets in his gun. You can't do anything. And
No,
then you got
you're
to
at the
be selling
mercy of
things
the market.
down. Go ahead, I'm sorry.
No, I just see you're at the mercy of the market at that point. If you sell, you're selling at a loss.
You got to sell something at a loss
Yeah.
just to raise money to buy something that's a bargain. So this stuff is really pretty simple, I would tell people, and this isn't really that complicated. And it's not like, Mike, you had to use a whole lot of math, and right? I mean, you don't have to be a math whiz to be successful as an investor, right?
Right. I have not gotten a calculator out to make any trades over the course of the past year. It's all been, very, very simple. Again, if you understand the concepts, you can apply those to any company, any stock, and relatively simple.
Let me do this. We already gone longer than I anticipated, so I'll wrap up, but let me ask you one last question. There's a lot of people we didn't get to pick. I didn't get to pick my parents. No one did. So I was lucky that my father discussed investing at the table, and I always had an expectation when I grew up, I was going to buy stocks like my daddy did. You had me around. I don't know to what extent to which your dad invested or not, and we hardly talked about stocks, but you had me around talking about it. You have Uncle Mark that you knew, bought. So folks, if you're in an area, well, I mean, a lot of people are, in neighborhoods. I mean, you think of a poorer part of the country, they may not have one person in their universe of connections, no family members, no aunts, no uncles, whoever invested. And I would encourage you be the one in your family to get started and start investing. And Mike, I guess the thing is, to what extent, I somewhat asked you this before perhaps, but to what extent did it impact you, if you can analyze yourself, to want to invest because you saw your uncles investing and talking about it? What kind of an impact did that have on you?
Well, I think a positive one would be the short answer. I think, like a lot of people, I was afraid to invest because I didn't think I had enough money. I didn't think I knew enough. But I think everybody would agree it's a good thing to save money. It's a good thing to put money aside for a rainy day. It's a good thing to plan for your future financially. And, the market in many ways allows you to do all of that. My perception of it prior to really getting in was that, it was a way to build wealth and, make your money grow for you. The misconception I had was that it was way more difficult than it really is. The influence of you and Mark and other family members over the years. I mean, I think just we as kind of like sponges. We absorb things. Some things they come and go. Some things stick, and it took me a long time to really. It took me a long time to pull the trigger, and part of that I think was probably just my own fear of the unknown. I didn't know what to expect, but I think a lot of people are probably in that position. They don't know what to expect, and for me, I was finally to a point where I I had enough money to where I could think about putting it somewhere because I didn't need it. The last thing I wanted to do was lose it. Um, so, the influence I had, well, I knew the good it could bring long term. I think anybody that's probably watching this believes in just the concept of investing. So, you know,
What I will say,
it,
go ahead.
no, I don't want to get too long winded, but yeah, I would just encourage folks if they're not in the market, if they're right where I was a year ago, to pull the trigger. Um,
And the thing I would say,
and,
and
and
you said this, I want to underscore it. Look, folks, if you go out to dinner, husband and wife, boyfriend, girlfriend, you can easily spend $100, $150. I mean, think of how much are you afraid of losing that $150? No. For $150, $200, you can get started in the market. You can buy some stocks at, as Mike suggested, he bought some things at $4. You can buy something at $8. You can buy Sirius satellite radios about $6 or so. You can get started, and one way to look at this, if you went to school, you would have to buy books. If you went to college, you'd have to buy books. If you're investing, don't think, well, that's not going to matter. That's not enough money to get started and make a difference. It'll make a difference in your education. It'll make a difference in the feeling you have about investing. And the biggest hurdle for almost anything is the lack of just getting started. The Chinese saying was a trip of 1,000 miles starts with the first step. Just take the first step. Go out and buy 5 shares. Go out and buy 1 share of something. Go out and buy 10 shares of a $5 stock. It's not so important the dollars you're going to earn off that little investment as much as how it will change you emotionally. And then when you have money on the table, you're starting to pay attention to the fluctuation in the market. Otherwise, you're just not going to pay attention, and you'll never get started. So just get started. Mike, I'll let you have the last word.
Well, thank you for having me on. I hope that kind of our discussion today helps some folks. If there's anything I can leave you with, it's that if you're right where I was a year ago, pull the trigger. You don't have to know everything. Quite frankly, you don't have to know all that much. With what we have today in the form of YouTube and Facebook and all the different digital publications, you've got more than enough resources to kind of self-guide your journey. So I would just encourage folks to do that.
All right. Thanks for being with us. And folks, we want you to get ahead. That's the bottom line. It's not just about being an investor. It's about being someone who participates in the growth of the American economy or the world economy, for that matter. And that's how you can really, as I've said so many times before in other videos, we work for cash flow. We invest for wealth. Thanks for watching. Mike, thanks for being with us. And we'll see you later, folks.